Movies followed by eating out is perhaps the favorite and only source of entertainment for many households in India. Indians are known to be big movie lovers, and movie stars are treated as demigods in the country. No wonder Indian film industry churns out 1,500 to 2,000 movies annually in 20 different languages, which makes it much bigger than Hollywood or the Chinese film industry. However, when it comes to gross box office collections, the Indian film industry lags behind at about $2 billion a year, which is 1/5 the size of Hollywood and 1/3 of the Chinese film industry. Box office collections are very low in India due to relatively poor screen penetration and also because of lower average ticket realization. The Indian film exhibition business is a huge business opportunity, but traditionally it has been dominated by single-screen theatres. However, the mushrooming of multiplexes over the last few years is redefining the film exhibition landscape with considerably better movie-watching experience for consumers and better economies of scale for the exhibitors. One of the leading names in the multiplex business in India is Inox Leisure, which has emerged as the second largest chain of multiplexes with a market share of close to 20% in terms of number of screens owned. Inox operates over 400 movie screens spread across 107 properties in 57 cities with a seating capacity of nearly 110,000 people. Inox has grown its operations aggressively with about 3.5 times increase in number of screens in the last 6 years. Also, it has equally aggressive expansion plans and targets to ramp up to about 700 screens over the next 24 to 30 months. Inorganic opportunities or acquisitions are an important part of Inox's expansion strategy. Its balance sheet is healthy enough to fund the organic and inorganic expansion plans. Despite an aggressive growth in the past few years, the debt-equity ratio stands at a comfortable level of 0.4x. And the company also has treasury shares, which could be used to raise about Rs 100 crore. With aggressive expansion plans to ride the opportunity offered by the rapidly expanding film industry in India, we expect Inox to deliver a growth of well over 20% in box office collections over FY 2015 to FY 2018. In addition to ticket sales, Inox could clock about 30% average annual growth rate in revenue from the sale of food and beverages and from in-cinema advertising. Consequently, the company is likely to build on its strong growth track record and post an average annual growth of over 20% in its revenue and net profit over the next couple of years. A healthy growth in profit, driven by better utilization and higher average realization per seat, is expected to improve its return ratios. We expect return on capital employed to surge to over 15% levels by FY 2018. All these factors make Inox an interesting investment opportunity to cash in on the improving discretionary consumption trend in India. We recommend a buy on Inox with a price target of Rs 285.